This is the comprehensive problem of basic variance analysis, problem 1012 from chapter 10. So Becton Labs produces various chemical compounds for industrial use. One compound called Fluidex is produced using an elaborate distilling process. The company has developed standard cost for 1 unit of Fluidex as follows. Materials purchased 12,000 ounces at a cost of $225,000. There was no beginning inventory. However, at the end of the month, 2,500 ounces of material remained on ending inventory. The company employs 35 lab technicians to work on the production of Fluidex. During November, the average worked 160 hours and an average rate of $12 an hour. The variable manufacturing overhead was assigned on the basis of direct labor hours. Variable overhead costs for November totaled $18,200. During November, 3,750 good units of Fluidex were produced. The company's management is anxious to determine the efficiency of Fluidex production activity. Required for direct materials used in production, compute the price and quantity variances. The materials were purchased from a new supplier who is anxious to enter a long-term purchase contract. Would you recommend that the company sign this contract? Explain. Then we must do direct labor hours, and then compute the variable manufacturing overhead rate and efficiency variances. Okay, so this was the given information. The standard cost is direct materials, 2.5 ounces for $20 per ounce at $50. Direct labor, 1.4 hours, $12.50 an hour for $17.50 per item. Variable manufacturing overhead, 1.4 hours, $3.50 an hour, $4.90 for a total standard cost for Fluidex of $72.40. Alright, this is just given information that came in the problem. So let's start with direct material variance. Alright, so very first thing, we must take actual quantity times actual price. And they told us that we spent $225,000 on materials. Then we must take actual quantity times standard price. And they told us that we had 12,000 ounces, and the direct material standard pricing is $50 per ounce. Sorry, $20 per ounce. So then this would be direct material rate variance. So this is a favorable $15,000 rate variance, price variance. Now let's do quantity variance. Okay, so we'll take actual quantity times standard price, and we calculate that above. And the actual quantity we had was 12,000. We're going to use actual production minus the ending inventory. So materials used minus ending inventory times our $20 price. And the reason that we use actual materials used in production, because we need to figure out the production quantity variance. So now we're going to use standard quantity times standard price. Okay. And we produced 3,705 units. We should use 2.5 ounces and we should multiply that by $20. So our quantity variance equals this actual minus standard, and that's unfavorable. And this is direct materials. Add that in. So, the question about direct materials were, the materials were purchased from a new supplier who's anxious for a long-term purchase contract. Would we do it? I would say yes, the contract should be signed. The new price of $18.75 per ounce is substantially lower than the old price of $20, resulting in a favorable price variance of $15,000. The material from the supplier appears to cause little to no production problems. There was a small material variance, but that could be due to anything. It may not be due to the quality of the product. Now let's see how we did in labor. Rate and efficiency variance. Alright, so we're going to have to take actual hours times actual rate Now, to get the actual hours, we had 35 technicians, it said in the problem, at an average of 160, and our average rate was $12 an hour. Now, if we want standard hours times actual rate, actual hours times standard rate, actual hours times standard rate. So we had the 335 times this times our standard rate, which is $12.50 an hour. So direct labor rate variance. So we had a favorable rate variance. Let's see what we have for efficiency variance. Now we're going to take actual hours times standard rate. And we already calculated this up here. And then we're going to take standard hours times standard rate. And standard hours was 1.4 times the number that we produced times our standard rate of $12.50 an hour. So, direct labor efficiency variance. And this is unfavorable. Part B says, in the past, 35 technicians employed in the production consisted of 20 senior technicians and 15 assistants. During November, the company experimented with fewer senior technicians and more assistants to save costs. Would you recommend this labor mix? Okay, so our total variance for labor, total labor variance equals this plus this, and this is unfavorable. So although we saved on the rate, we actually lost money from this, from our direct labor. And that's because our efficiency variance was even more than our rate variance. Therefore, I wouldn't suggest that we use more assistants. We would be better off going back to the previous mix. We didn't net that 50 cents per hour that we saved didn't net us money. It cost us $1,575. Now the last part. So, compute the variable overhead rate and efficiency variance. What relation can you see between this efficiency variance and the labor efficiency variance? Alright, talk about overhead. Variable manufacturing overhead variance. Alright, so the very first thing we do is actual hours times actual rate. And they gave us this amount in the problem. Variable manufacturing overhead was $18,200 for the month. Now we need actual hours times standard rate. And the hours were the 35 times the 160 times the standard rate for variable overhead, which was given in the problem as $3.50 an hour. Okay, so this is our overhead rate variance. So this is favorable rate variance, right? Favorable rate variance. Now let's see about the efficiency variance. Alright. So we will do actual hours times standard rate, which equals this. And then we will do standard hours times standard rate. Now, the way we get to the standard hours is we take the units produced and we multiply by the 1.4 hours, and then we're going to multiply that by our standard rate. Efficiency variance. And this is unfavorable. So how do the labor and the overhead rate efficiency problems relate? Well, they're both unfavorable, but here's why. Because manufacturing overhead is based on 1.4 hours, it's based on direct labor hours. And if we are inefficient, or it takes us longer because we were using assistants and not senior technicians, then if we're inefficient in direct labor, we'll be inefficient in our variable manufacturing overhead because it's taking us longer to do the process. So this was a basic analysis of all the variances. Oops, sorry.